Conversely, the Russell 2000, representing the heartbeat of American small-cap companies, experienced a more significant dip, underscoring concerns about domestic economic growth and tighter financial conditions affecting smaller enterprises. This is a critical divergence, suggesting that while large-cap tech continues to hold sway, the broader economic foundation might be wobbling for those companies more susceptible to local fluctuations. We also saw a ripple of concern emanating from Europe with news that Deutsche Bank offices faced raids by German authorities regarding money laundering allegations. While this specific event is localized, it serves as a stark reminder of the ongoing scrutiny on financial institutions and the potential for regulatory pressures to create headwinds in the banking sector globally. All these elements combined paint a picture of a market grappling with conflicting signals, navigating between innovation-driven optimism and underlying economic anxieties. Shifting our focus to the sentiment influencing long-term planning, we saw headlines today highlighting a common misconception among Americans regarding the ideal retirement age. Many perceive 63 as the target, yet financial experts are quick to point out that this number often falls short of what's truly needed to sustain a comfortable post-work lifestyle. This speaks volumes about the gap between aspiration and financial reality for many, emphasizing the importance of diligent planning, realistic expectations, and potentially, working longer or saving more aggressively. It's a call to action for individuals to reassess their financial blueprints in an era where longevity is increasing, and traditional retirement models are evolving. In a related vein, another timely piece of advice making the rounds focuses on the importance of rebalancing portfolios. In a market characterized by rapid shifts and sectorial rotation, the counsel to re-evaluate and adjust your holdings couldn't be more pertinent. It's not just about setting it and forgetting it. Proactive management, ensuring your asset allocation aligns with your risk tolerance and financial goals, is crucial to navigating these dynamic waters. As certain sectors rally and others recede, maintaining a balanced perspective and disciplined approach to your investments is what often differentiates long-term success from short-term reactivity. Turning our attention to the bedrock of global finance, the bond market, we observe some telling movements. The yield on the benchmark US 10-year Treasury note saw a modest but notable increase. While seemingly small, this UPTICK carries significant implications. A rising 10-year yield often signals a few things. Either markets are anticipating stronger economic growth, which could lead to inflation, or they're pricing in the possibility of the Federal Reserve maintaining a tighter monetary policy for longer than previously expected. For companies, especially those reliant on debt financing, this translates to higher borrowing costs, potentially impacting future expansion plans and profitability. Furthermore, movements in the bond market frequently act as a precursor to changes in equity market sentiment. As bond yields rise, the risk-free rate of return offered by treasuries becomes more attractive, potentially drawing capital away from riskier assets like stocks. We also noted a slight increase in the CBOE Volatility Index, or VIX, which measures market expectations of near-term volatility. This rise, coupled with the yield movement, suggests an underlying current of uncertainty and a heightened awareness among investors of potential market choppiness ahead. The bond market, in its quiet, unassuming way, is often the first to whisper what the equity market will eventually shout. While explicit central bank announcements might not have dominated today's headlines, their influence, or the market's anticipation of their actions, is palpable through currency and bond movements. The slight weakening of the euro against the US dollar and a marginal decline in the dollar index itself points to a complex interplay of global economic forces. A weaker euro can reflect concerns over the eurozone's economic health or expectations of differing monetary policy trajectories between the European Central Bank and other major central banks. For multinational corporations, these currency fluctuations directly impact their reported earnings, making exports cheaper or imports more expensive. The rising US 10-year Treasury yield, as we just discussed, is a direct reflection of how the market is internalizing the Federal Reserve's potential path forward. It suggests that despite recent data points, the market is still bracing for the possibility of interest rates remaining elevated, or even moving higher, should inflation prove more persistent than anticipated. Central banks globally are walking a tightrope, attempting to tame inflation without stifling economic growth. Every data release, every bond market flicker, is scrutinized for clues on whether central banks will lean hawkishly or dovishly, and for now, the market seems to be factoring in a continued vigilance against inflation. This is where the story truly gets compelling today, as the commodity markets delivered some truly stunning movements. Let's start with gold, which experienced a significant rally. This surge in the price of the precious metal is a classic sign of increased geopolitical tensions and rising inflation expectations. Gold is traditionally seen as a safe haven asset, a store of value when confidence in conventional currencies or financial stability wanes. Its recent climb suggests investors are seeking refuge amidst global uncertainties, perhaps fueled by ongoing conflicts or a renewed concern about the purchasing power of their money. This has profound implications for portfolio allocation, as a flight to safety can signal deeper anxieties about the economic outlook. Next, we look at oil, with both West Texas Intermediate and Brent crude registering strong gains. This rally in oil prices is typically driven by a combination of robust demand recovery, particularly from major industrial economies, and persistent supply concerns. Geopolitical instability in key oil-producing regions can quickly add a risk premium to prices, disrupting supply lines or threatening production capacity. For consumers, this translates to higher costs at the pump, impacting discretionary spending and contributing to inflationary pressures. For the energy sector, as evidenced by the positive movement in energy exchange-traded funds, it's a significant boon, boosting revenues and profitability for exploration and production companies. But perhaps the most striking development in commodities today was the precipitous decline in natural gas prices. This was not a minor adjustment. We saw a staggering drop, nearly halving its value in a single day. This kind of monumental shift is usually the result of a sudden and dramatic imbalance between supply and demand. Potential drivers include unusually mild weather forecasts across major consumption zones, significantly reducing heating demand. High storage levels, built up during periods of lower demand or increased production, can also exacerbate price declines as traders anticipate an oversupply. The implications of such a sharp drop are widespread. Lower energy costs for industries that rely heavily on natural gas, potentially easing inflationary pressures for consumers in specific regions, and a significant challenge for natural gas producers who may face reduced revenues and profitability. This massive swing highlights the inherent volatility and sensitivity of energy markets to both fundamental supply-demand dynamics and short-term weather patterns. It's a stark reminder of how quickly fortunes can change in this critical sector. Diving into specific sectors, the narrative of divergence continues. The technology sector, as represented by the Nasdaq, showed overall strength, though it was a mixed bag among the individual giants. Nvidia, the powerhouse behind much of the AI revolution, continued its upward trajectory, signaling sustained investor enthusiasm for its dominant position in artificial intelligence infrastructure. Microsoft and Google also posted positive movements, underscoring the enduring appeal of established tech leaders with diversified revenue streams and robust cloud computing businesses. However, we saw some of the other tech titans, including Apple, Amazon, and Meta, experience slight pullbacks, perhaps as investors took some profits after recent rallies or reallocated capital. Tesla, a perennial headline maker, saw only a marginal increase despite Elon Musk's ambitious plans for a significant capital expenditure surge and robotaxi expansion. This muted response comes on the heels of its earnings report, which indicated a fall in profits, suggesting investors are weighing future growth potential against current profitability and execution risks. Outside of technology, the financial sector, as indicated by its key exchange-traded fund, remained largely flat. This might reflect a wait-and-see approach from investors, influenced by the Deutsche Bank news on one hand and the slightly rising bond yields on the other. In stark contrast, the energy sector rallied strongly, directly benefiting from the surge in oil prices we discussed earlier. This illustrates how macroeconomic factors, particularly commodity price movements, can significantly influence sector-specific performance, creating clear winners and losers in the short term. Now, let's turn our gaze to the dynamic world of digital assets, a space that always seems to capture attention. Both Bitcoin and Ethereum experienced pullbacks, with Bitcoin seeing a notable decline from its recent highs. This dip in the leading cryptocurrencies naturally had a ripple effect across the broader crypto market. The impact on companies deeply invested in the digital asset space was immediate and evident. MicroStrategy, the software firm famously known for its aggressive strategy of accumulating Bitcoin as a treasury reserve asset, also saw its shares decline. This directly correlates with the price movement of Bitcoin, illustrating the inherent leverage and volatility associated with MicroStrategy's corporate strategy. For investors in MicroStrategy, their fortunes are inextricably linked to Bitcoin's performance, making the company a bellwether for corporate adoption of digital assets. This period of consolidation or pullback in crypto raises several questions. Is this a healthy correction after a period of rapid ascent, allowing the market to digest gains and reset? Or does it signal a waning institutional appetite, perhaps influenced by a more risk-off sentiment in traditional markets? The implications are significant for the long-term narrative of cryptocurrency adoption. While the corporate treasury strategy championed by MicroStrategy demonstrates a bullish conviction, a sustained decline in Bitcoin could put pressure on such balance sheet strategies, prompting a re-evaluation for other companies considering similar moves. The crypto market remains a high-stakes arena, sensitive to both macroeconomic tides and its own unique supply-demand dynamics. As we look towards the next trading session, the themes of divergence and volatility are likely to persist. Investors will be keenly watching several key areas. Firstly, the performance of the US 10-year Treasury yield will remain a critical indicator, signaling market expectations for interest rates and inflation. Any significant movement here could dictate the direction for both equity and bond markets. Secondly, the commodity markets, particularly natural gas and oil, will be under intense scrutiny following today's dramatic moves. Any further news regarding weather patterns, supply disruptions, or geopolitical developments could trigger renewed volatility. We should also anticipate continued focus on the technology sector, with investors differentiating between companies that can maintain robust growth even in a challenging macro environment and those facing increased pressure. Finally, any further regulatory news pertaining to financial institutions, or fresh economic data releases, particularly those related to inflation or employment, will likely be major catalysts for market sentiment. Staying agile and informed will be paramount. In summary, today's market action has been a masterclass in complexity and nuance. We've seen a clear separation between the resilient performance of mega-cap tech and the struggles of small-cap companies, reflecting a deeply divided economic outlook. The bond market is quietly signaling persistent inflation concerns and a watchful Federal Reserve, while global currencies reflect a delicate balance of international economic health.